All right, let's dive right in. Today, we're going to talk about this incredible tension, this constant push and pull that's really at the very heart of all financial markets. It's this epic battle between what looks like pure chaos and some kind of mysterious hidden order. When you look at a stock chart, it's easy to think, what am I even looking at? Is this just a totally random, chaotic mess with absolutely no rhyme or reason? Is that the whole story? But what if it's not? What if there's this hidden force, almost like a kind of financial gravity that's always there, constantly pulling everything back towards the center? The idea that what goes way up or way down must eventually come back to some kind of average. This idea is called mean reversion. Okay, so here's the crazy part. The origin of this huge financial idea, it has absolutely nothing to do with markets. Nope. To find it, we've got to go way back in time, away from any trading floor and into a 19th century science lab. So this is Sir Francis Galton. And back in the late 1800s, he wasn't looking at stock tickers. He was studying something, well, a lot more human. He was looking at the height of parents and their kids. And what he found was this amazing tendency, which he summed up perfectly. Extreme outcomes tend to be followed by more moderate ones. He called this regression toward the mean. And what it means is this. He noticed that really, really tall parents tended to have kids who were, yeah, still tall, but they were usually a little bit closer to the average height for everybody. The extremes didn't just keep getting more and more extreme. They would kind of pull back or regress toward the middle. And this is where we make the jump from biology to finance. It's actually a perfect analogy. Think about it. In biology, you have random genetic variance driving height. In markets, you have human overreaction to news driving prices. But the pattern is the same. An extreme outlier, whether it's a 7-foot-tall dad or a stock that's shot up way too fast, tends to be followed by a correction back toward that average. So, okay, if it's not genetics pulling stock prices back to their average, what is it? Well, the answer isn't in some complex math formula. It's inside our own heads. It's all about the predictable and kind of weird ways our brains work. See, our brains are basically hardwired with these little glitches, these cognitive biases that make us, well, kind of bad at judging probability, but absolutely fantastic at overreacting. We get hooked on stuff like recency bias, where we think whatever just happened is going to keep happening forever, or the hot hand fallacy, that feeling that a winning streak just can't end. We love a good story more than the messy truth. And all of that together, it creates what's called the overreaction hypothesis. We are the ones who push prices to crazy unsustainable levels, creating the perfect setup for a snapback to the mean. Just look at how this plays out. Recency bias makes us put way too much weight on the latest news. So some bad news drops and boom, the price doesn't just go down, it plummets way below where it should be. The hot hand fallacy makes us see a stock on a tear and think, I gotta get in on that, usually right at the top. These predictable mistakes we all make. That's the fuel that powers the whole mean reversion engine. And listen, this isn't just some dusty old theory from a textbook. This is the real deal. It's the foundation for actual high-stakes trading strategies. People have built entire careers, massive fortunes, just by betting that prices will eventually snap back to where they're supposed to be. So how does it work in practice? Well, the process is pretty straightforward. First, you have to figure out what normal even is for an asset. That's your mean. Then you wait. You wait for the market to get all emotional, either way too excited or way too panicked, and push the price way, way out of line. That's your signal. You jump in, betting on a return trip. But, and this is the most important part, you have to have super strict risk management. Why? Because sometimes normal changes for good. And to find these moments, traders have a whole toolkit of indicators. You've probably heard of some of them, things like Bollinger Bands or the RSI. They're all basically designed to do one thing: signal when an asset has been stretched too far, like an elastic band. They're trying to spot when something is statistically overbought or oversold and is probably due for a snapback. But here's the thing. What happens when you start thinking of this statistical tendency as an unbreakable law of physics? What happens when you bet everything, and I mean everything, on the idea that things have to return to normal? Well, you get one of the most spectacular, terrifying collapses in the history of finance. Let me introduce you to long-term capital management, or LTCM. I mean, this was a hedge fund dream team. We're talking PhDs from the best universities, even Nobel Prize-winning economists on the board. Their entire super complex strategy was built on one simple idea: mean reversion. They were betting that tiny little price differences between similar assets would always, eventually, correct themselves. They honestly thought they had found the secret code to printing money. Now, the profits on each individual trade were tiny, microscopic even. So to make real money, what did they do? They used an absolutely insane amount of leverage. They borrowed and borrowed to amplify their bets. At their peak, they were controlling over, get this, $1.25 trillion in positions. The scale of it is it's almost impossible to wrap your head around. And then it happened, the trigger. In 1998, Russia defaulted on its debt. Now, in their super smart models, an event like this was basically impossible. It was a statistical anomaly so rare it shouldn't happen in the lifetime of the universe. And all of a sudden, their sure thing trades didn't revert to the mean. No, the panic was so intense that everything started flying in the opposite direction. The result? Absolute catastrophe. In just 1 month, August of '98, the fund lost 44% of its entire value. Their bets failed so completely, so spectacularly, that they were on the verge of taking down the entire global financial system with them. It got so bad, the U.S. Federal Reserve had to step in and orchestrate a massive, unprecedented bailout. Whew, so after a story like that, what's the takeaway? What's the lesson here? How do you balance this incredibly powerful force of reversion with the very real risk of a complete meltdown like LTCM? Well, it really starts with understanding that mean reversion isn't the only game in town. You've got its polar opposite, momentum. That's the idea that trends just keep on trending. So a mean reversion trader is betting on a reversal, right? But a momentum trader is betting on continuation. The key is that neither one of these strategies works all the time. The real trick is trying to figure out which kind of market you're actually in. And that, right there, leads us to the single most important lesson of this whole thing. Mean reversion feels like a law of nature, like financial gravity, but it's not. It is a powerful tendency. It's driven by probabilities and, as we saw, by messy human psychology. And because of that, you always have to remember that sometimes the mean itself can just shift permanently. Which brings us to one final, really interesting question for the future. Today's markets are dominated by high-speed algorithms, many of which are programmed to trade on these very principles of mean reversion. So as these machines take over, are they going to make markets more rational and smooth out all our human mistakes? Or are they just going to make markets overreact and snap back to the mean faster and more violently than ever before?